Despite expected drops in home sales, the Fed is sticking to its pledge to keep raising interest rates as long as inflation stays high. According to the Census Bureau, sentiment among house builders and developers has dropped to its lowest level in 2 years. Builders are slowing down as construction expenses continue to climb. Furthermore, Americans are canceling home buying contracts at the greatest rate since the COVID began. In September, nearly 1 in every 5 house sellers reduced their asking price to attract buyers.
Now, you've also recently had about 1 in 5 homes sold to institutions. In some markets like Miami, 1 in 4 homes were being sold to institutions. Some institutions, especially pension funds, might actually be forced to sell properties because their bond portfolios and equity portfolios are getting completely decimated. So rather than sell bonds or sell their stocks and equities at lows, they could break the piggy bank, so to speak, of real estate. However, it takes time to sell real estate, especially if you're a pension fund with thousands of homes. So, do we expect to see price drops like the global financial or the great financial crisis? Probably not, but we do expect to see some substantial pain, mostly because while we don't expect a short sale and foreclosure crisis, which is where prices fell 40 to 50%, because after all, when you're doing a short sale or foreclosure, you don't care about how much of a loss you're taking because it's not your loss, it's the bank's loss, right? And so those short sales really tanked the market in 2008. We don't really expect to see that kind of disaster again. While it's entirely possible, we expect more of this kind of crash, depending on whether or not we have a recession. Take a look at what Mark Zandi says, an economist who studies this pretty regularly on Twitter. He mentions here that sellers are caving. They understand that potential buyers can't afford the price they want due to the surge in mortgage rates, the price the sellers want, right? And unlike times in the past when rates rose, they know they won't be coming down anytime soon. And so sellers could also be motivated by fear. There's that word. And we're going to have real fear, by the way, when we actually not only start seeing these month-over-month declines, which we're seeing now, but when we actually do year-over-year comparisons and we start looking from a low to a peak and we go, oh my gosh, year-over-year prices are really coming down, then I really expect fears to explode. But anyway, Mark goes on to say here, buckle up, he says, assuming rates remain near their current 6.5% and the economy skirts a recession, then national home prices will fall almost 10% peak through the trough. Well, we've almost hit that because we're already down about 6.5% nationwide. Now, most of these declines will happen sooner rather than later. Exactly, we've already seen that. However, he does say house prices will fall 20% if there's a typical recession. Now, I usually find that Wall Street economists tend to be pretty lowball on their actual expectations of how long pain will last. It seems like economists are this breed of optimists. And the reality is, the difference here is what you want to pay attention to. If you think we're actually going to have a real recession and the Fed is going to push us through and drag us through a recession with real sustained rate hikes, yeah, we'll probably have a more substantial fall in real estate prices. Now, we'll look at some specific areas in just a moment, but what's worth remembering is no matter what, if all of a sudden tomorrow inflation comes in at, let's say, 5% and the Federal Reserve says, you know what, we're not going to raise rates anymore, we're done, we're doing a 0% rate hike, then we could see mortgage rates plummet very quickly. And we could actually just see what will end up proving to be a temporary dip in the real estate market, where you kind of see like this 6.5%, 8% decline, and then it's kind of back off to the races and money printing because the Fed screwed up. That's possible, but that's a very rosy outlook. And so we have to be prepared to react, not based on what we believe, but what the Fed actually does. So, I'm ready to move. If tomorrow inflation plummeted to say 5% and then it went down to 3% by the end of the year, and the Fed's like, we're done with rate hikes, heck, I might consider going shopping for real estate now.
Now home affordability has fallen to the lowest levels ever, and people just don't want to buy a home. That's why home sales began to fall in February, they continued to fall in March, and then April, and then May, and then June, and then July, and now we have seen home sales fall for 7 consecutive months, and for the first time, we're also seeing home prices start to fall. This is where now all those people that kept saying that inflation was transitory here, who said that there's no housing market bubble here, are now starting to get worried about the housing market. Some people are still saying that the housing market's strong, there's nothing to worry about, you don't got to worry about a potential recession. But some people, more and more people, are starting to say that it looks like that we're going to see a recession in 2023 and that our housing market, along with other asset classes, are going to get hurt, which has everybody wondering what's coming next in 2023 and 2024 and on. Now, when people are talking about or worried about a potential housing market crash because home prices and mortgage rates have gone up, that's only the first piece of the puzzle. So let's start by talking about that. In 2020, the median home in America was selling for around $329,000, and if you put down 10%, that would mean that you're borrowing $296,000. And back then, you could get a 30-year fixed-rate mortgage for 3.1%, which meant your monthly payment was going to be $1,264. In 2022, home prices have gone up quite a bit since then. Now I'm talking about towards the end of 2022. Well, that same median home today is going to cost you $440,000. So you're paying a lot more dollars to buy the exact same home. If you put down the same 10%, well, now you're going to borrow about $396,000, meaning you have to borrow about $100,000 more. So not only do you have to pay more, you also got to borrow more dollars, but you're also going to pay a much higher interest rate to borrow those dollars today than you would have just a couple of years ago. So now you're going to pay 6.7% around today's time, which means that your monthly payments are going to go up to about $2,555 a month, which is double what you were paying just a couple of years ago. So if your income has not doubled since 2020, it is going to be more difficult for you to go out and buy a home, which is why so many people are struggling to buy a home. Now, the reason why this becomes so important today is because the Federal Reserve Bank is on a mission to bring inflation down. How are they working to bring inflation down? By raising interest rates. They say that they're going to continue to raise interest rates until they can bring inflation down to 2%, even if that means hurting the housing market, even if that means hurting the economy. And now that we're starting to see home prices go down, that means if you don't have a lot of equity in your home, you could potentially go underwater on your home. And this is a situation that you want to start thinking about because the average home buyer is putting only a 6% down payment down on their homes. Meaning, people who have bought a home recently in the last year or so only have 6% equity in their homes. So if we were to see the housing market fall by say 10%, which really isn't that much considering the huge run-up that we saw in the last 2 years, you're going to have a lot of people who are underwater on their homes. Well, this entity right here, Fannie Mae and Freddie Mac, has talked about the economic slowdown. They have said that they believe that we're going to be entering a recession. However, the recession will be mitigated because of the strong housing market. That's what they said in the early part of 2022. And so what they're saying is that because the housing market was so strong in 2022 and is so strong, that is going to cushion the recession. That's the reason why the recession won't be bad. That's the reason why so many people will not lose their jobs. Well, this is now where you start to run into the chicken and the egg dilemma, or what's going to cause what. Because now if the economy does slow down and it does hurt the housing market, now you start to create this negative spiral. And this is where now you can start by looking at the lending business, and the reality is lenders are getting hurt. We've seen a number of lenders do mass layoffs, and we've seen other lenders completely shut their doors because people aren't interested in continuing to go out and buy a home. If the Federal Reserve Bank stays true to their word, to doing whatever it takes to bring inflation down, that means they're going to have to raise interest rates significantly. If they keep raising interest rates, it's going to continue to become more expensive to buy a home. As it becomes more expensive to buy a home, home prices will have to correct. Sellers will not be able to sell their home at the same price today at an 8% mortgage or a 7% mortgage as they could have when they were selling the home at a 3% mortgage. And so you would have to see some sort of correction in the housing market. Now, if that is coupled with people losing their jobs or seeing smaller incomes and they cannot continue to pay their mortgages and they're potentially underwater in their homes, well, then you could see people not paying their mortgages. If people don't pay their mortgages, well, then you have all the dominoes that I just talked about. But again, it all hinges on people paying their mortgages or not, but that is ultimately going to depend on what the Federal Reserve Bank is going to do. We're seeing a huge influx of new adjustable rate mortgages. We're going to see the cost and the effect of that in 2027, after the 5 years of the adjustable rate mortgage expires.
The 30-year fixed mortgage rate is at 7.32%, up 15 basis points from the previous week. For homeowners looking to refinance, the national rate for a 30-year fixed refinance is 7.3% today, up 15 basis points from the previous week, a considerable increase over the previous year's rate of 2.88%. Goldman expects a 22% drop in new house sales before the end of the year, a 17% drop in existing home sales, and an 8.9% drop in overall housing GDP. Goldman predicts that these figures will fall even lower in 2023, with a 9.2% drop in housing GDP the following year. Thank you so much for watching. Like, share, comment, and subscribe to help this channel.